Money FM 89.3. Best of breakfast. The bigger picture, only on Money FM 89.3.
Hi, I'm Willie Keng, and this is The Bigger Picture. Now, we're looking at a more polarized world that will force countries to focus on domestic growth and decouple from globalization. Now, meanwhile, a new Trump administration this year in the US will be the most visible in the trade, energy, and industrials sector. And short-term interest rates will also likely come down, with money market yields coming down as well. So how should we make of all this? Now, global wealth and asset manager Lombard Odier has published its Outlook 2025 report and its 10 investment convictions for 2025. So for all these insights, we are joined by Homin Lee, Senior Macro Strategist of Lombard Odier. Good morning, Homin. Welcome to the show.
Good morning. Happy New Year. Thanks for having me.
Happy New Year. Now, I just want to quickly dive into investors' concerns this year. I mean, we're talking about inflation risk, US tariffs on some of the global economies. I just want to get your views first on macro. What's your take on the US Fed interest rates of this year?
So we had a new language from the Federal Open Markets Committee in December, and it seems that the committee is now beginning to be a little more cautious about cutting rates too much from the current levels, given the potential, policy changes on the horizon. So our base case scenario for the U.S. is that the interest rate cuts, there will be some more interest cuts in our view. So maybe two more 25 basis point cuts. And then we think the Fed will basically stop and keep the policy on hold for an extended period of time, because they need to figure out and digest the new policy initiatives from the Trump team. And for that reason, we simply assume that the upper bound of the federal funds rate range will basically fall to 4% and stay there until the end of the year, and will likely remain that way, potentially well into 2026. And this is the level that we expect to be the neutral level for the U.S. Now, we think the U.S. economy can deal with it. We are not assuming any sort of recession. The underlying growth momentum remains positive. In fact, you will probably get some boost from, at least the initial boost from Trump's, tax cuts and deregulation this year. But, so the underlying momentum will be pretty positive, and therefore the economy can take some hits, and consumers in fine shape. The real income gains are still there, and their balance sheets are still pretty clean. So, we still expect 2+% GDP growth for the U.S., and despite the rate cuts, maybe not going as far as some market participants initially anticipated.
Now, speaking of positive momentum on US GDP, we do note that you have some top conviction calls. So you guys are currently underweight sovereign bonds, overweight equities. Now, tell us a bit more about this, and how does US fiscal policy have an impact on your current conviction calls?
So when you don't have recession, generally speaking, it's a good idea to focus on risky assets. And we are definitely facing the prospect of, a high octane economy in the U.S. under Trump 2.0, because he now has the support of the Congress, right, in his second term. And therefore, he will be in a pretty good position to enact at least some of the tax cuts and deregulations he put forward during the presidential campaign. And that's positive for growth. And as you mentioned at the start of this segment, the decoupling process that's happening at the global level would entail some fiscal spending to cushion the impact for businesses. And that's definitely true for the U.S. So we'll likely see greater deficits for some of the developed markets like the U.S. and also for China as it deals with the property sector issues and potential kind of offset that's required for the tariff shock from the U.S. So overall, the supplies of bonds will be slightly greater for the sovereign bonds market. So definitely bonds play an important role in the portfolio. So you still need them for the overall diversified portfolio. But in thinking about the tactical positioning, we think it makes sense to still keep the focus on equities at the expense of sovereign bonds like the U.S. Treasuries for this reason.
Yeah, now speaking of equities, I just want to shift gears and move into Asian markets. Let's talk about China and Japan. What are some of the recent changes in your market outlook, from last year as compared to this year with regards to Japan and China?
So we remain neutral on China's economic prospects. There are a lot of, long-term challenges, but at the same time, we have to be mindful of the fact that the leadership and the authorities are trying to put a floor for growth, and they're still putting forward a lot of stimulus efforts. So these two basically even out in our view, and therefore it's still a bit tricky for us to be very aggressive in either way for the market. Now, in terms of the changes in our outlook for Chinese market in particular, we were thinking, before the end of last year that the authorities would be pretty keen to defend the red line on the renminbi at around 7.3, which has been defended for quite some time now, and it looks like they're still trying to at least anchor the market expectation around that level. But at the same time, the underlying challenges are there, and the authorities are beginning to respond to it. So they're considering maybe additional rate cuts, more liquidity injections to the economy, and that necessitates some tolerance of weaker renminbi as we go forward. And it looks like they're beginning to water down the red line around 7.3. So we changed our forecast on the renminbi against the US dollar from, roughly, slightly below 7.3 to now 7.5. And we think it's quite likely if Trump will likely introduce these tariffs on China. If that happens, they will probably engineer a one-off devaluation of the currency to basically provide a bit of cushion for the country's exporters. And so that's the likely outcome, maybe in the middle of this year. But on top of that, they will have to introduce fiscal stimulus to ensure that they get some offsetting boost for the growth. So we're still assuming 4.5% growth for China this year.
Now, speaking of currency devaluation and also investors' concern that China might be actually going down on a deflationary spiral, what's your view on China as part of an investor's portfolio equity allocation here? And what sort of risk should investors actually pay attention to?
So for us, China is basically a diversifier you can use in your allocation to broader emerging market equities. So when we say neutral, we're basically saying that within the emerging market equity allocation, you basically, maintain the weights for China closer to the benchmark. So, there are good enough reasons to keep it neutral. So you don't necessarily have to be super negative about the market. As I mentioned before, the authorities in the process of maybe trying to boost the economy. So that definitely helps a bit at the margin. But broadly speaking, it's very difficult to consider a standalone allocation still at this juncture, given all kinds of problems. And one of the problems is the deflationary risk. If you look at the credit indicators, demand is pretty low. It's going to take a while for the economy to work through the inventory overhang in the property sector. And also the geopolitical challenges are there. We've just gotten the news that some very well-known battery and consumer internet companies are now added to the blacklist by the U.S. Under this idea of civil-military fusion, which means basically the U.S. will be always suspicious of any business in China, potentially doing, cooperating with the military arm there. So it's a very hazy concept. It could potentially worsen the bilateral relations, and definitely we have the Trump team coming in. So the overall outlook, very difficult for us to use a standalone allocation to China, but as part of the broader emerging market equity allocation, it's okay to give a benchmark weight, and this is where we stand on the market.
One more question before we let you go, Homin. Coming to this year, 2025, I just want your take on the fourth quarter 2024 earnings seasons, which we'll be reporting pretty soon. What are you guys expecting?
So we still think for the favored markets, we currently favor U.S., Japan, and Taiwan. For these markets, we think the fourth quarter earnings season will be pretty positive. For the U.S. this year, we think there's a pretty decent chance that the market can generate a double-digit earnings growth. And actually, we similarly for Japan and Taiwan. For the U.S. in particular, you'll likely get a similar level of sales as last year, but you likely get some additional boost from tax cuts and deregulation. So this is basically what we are assuming for, and the fourth quarter earnings growth will probably provide some good evidence for that trend.
We have been speaking with Homin Lee, Senior Macro Strategist of Lombard Odier. Thank you so much for your insights, Homin.
Thanks for having me.
Stay with Money FM 89.3.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance. To listen to more great interviews, download our podcasts at audio.sg or download the audio app. That's AWEDIO, audio at the App Store and Google Play.